Okay, we're going to go ahead and finish up our last chapter in chapter 15, which is all about analysis of the financial statements. Now, the reason why we usually do this, one is to basically get a lot of checkpoints, seeing how well our business is doing. And we usually take this with the basic financial trend statements, and we're going to try to discover trends, either numbers going good or numbers going bad. Now, usually for a good set of trends, we'll take a 3 to 5 year comparison. But for most of us, we're going to compare usually 2 years. So, previous year with the current year. Now, mostly for certain people, they really look at these analysis for different purposes. Like small businesses, it's mostly their performance. While financial analysis will analyze stock investments. They want to make sure they did do the correct stocks. Auditors are going to look at the health of the company. Creditors are going to determine risk. And basically anybody else is going to look at it in their own terms. Now, for us to do a proper analysis, we do need what is known as an annual report from the corporations. And usually, if we just want to do our own audit or just a comparison, we can actually go to SEC.gov and look at these forms for any publicly traded company. Because all of them are required to file annual and quarterly reports. They're known as a 10K and a 10Q. We also want to provide these reports. We're going to be providing an overview of the business, which basically would mean they'll check the industry, compare with them, the business's growth strategy, what brands that they have, risks, and even company competitors. It will list a lot of information to help us understand what the business is. Another part of the annual report is also the management's discussion and analysis of financial condition and results of operations. Woo! Mouthful there. They're known as the MD&A. Out of all that, they got a very simple acronym. So, this document that's part of the report is usually just there to help investors understand what is going on, but it looks at the point of view of the managers. So it can present quite a bit of bias on the financial condition and results. And this will often provide, also because it's a management decision, a forward-looking into the future. So investors can estimate what future earnings will be. Then we also have the classic, what most accountants do, is the report of the independent registered public accounting firm, or better known as the auditor's report. And this audit report, basically what auditors do, they're going to attest to the fairness of the financial statements, basically making sure that they are correct. They also go on to make sure that they follow the strict guidelines of the generally accepted accounting principles. Again, they're known as GAAP. They also go on test out the internal controls of the company, making sure they're still effective. And these are always performed by independent external auditor. Again, that would mean that the auditor has no ties to any part of management, ownership, or any other things with the company. They're completely separate. And that was a big issue that was happening with a lot of fraud going on. So companies definitely make sure that whoever's checking or doing the auditor's report has no ties. Okay. So in this report, they do file one of three opinions. One is known as an unqualified opinion, which basically means everything is good in material aspects. It's presented fairly, everybody can understand it. A qualified opinion, that's when it happens, means the financial statements are almost there, but they are including a departure from GAAP, which of course the auditor will take a note of. And then of course, if they find out that the forms are completely bad, the statements themselves, they're going to issue an adverse opinion, which would basically mean that the company better clean up their act very quickly, or they're going to receive penalties from the SEC, investors are not going to invest in it, so forth and so on. Other items that are in basically the 10K, the annual report, is of course our basic financial statements, the balance sheet, income statement, statement of stockholders' equity, and the good old statement of cash flows. All those should appear, and for most companies, it's going to be multiple years. Again, to allow us to do the proper analysis, comparative. Then, to help us out even further, annual reports are also going to have notes to the financial statements. And all this is basically they explain specific items to help us get an insight of what's going on with numbers and the information that is provided within the financial statements. That's it. A lot of stuff goes into this report. Again, when you take more and more accounting classes throughout your college career, you're going to get into these reports. I know believe in your capstone class, that is just an auditing class. So you definitely get to look at how to issue out an auditor's report for the annual reports. Now, when we look at these financial statements, there is different ways that we can actually analyze them. And we usually put them all together, so even though they're different ways, we like to eventually put the bigger picture and put them all together to go, yeah, this is what's going on. Now, to me, there's two ways we can look at it. There's one called the horizontal analysis, or trend analysis. And this one looks within the company. The other one is a vertical analysis, which looks at the competitors. You can easily compare against competitors with that. So, the first one that we got going on is, of course, horizontal. And we're going to pretty much compare a series of financial years over a period of time to see how well we've increased or decreased. And again, we have basically the horizontal and the trend. Horizontal typically compares 1 year to the next. It's a little bit easier. And we have this basic formula. We take the current year minus the base year amount, and then divide by the base year. So basically, current year minus previous year, divided by previous year, and times by 100 to get our percentage, because it's always in a percentage. So, this is how an income statement will look. We also do it for the balance sheet, but when we look at computing it, this is how they did, and this is how we got to 6.8%. They took 858,000 minus 803, which came out to 55, and then divide by 803, so 2019. And then, of course, times it by 100. I'll give you your percentage, which is 6.8. Usually it's one decimal place, but always on your homework and on the exam and the quiz, you have to compute. Make sure you read how many decimal places. Always a good check. But basically that's all that's going on here. We compare and we look. What we're looking for when we do a horizontal is basically what changed. Did it change for the good or did it change for the bad? Then if it's significant, we go, okay, you may need to check into that. Why did it do so bad? So, some things here, we know we've increased our sales by 6.8%, which is not bad. We also know this, our selling expenses, they've actually increased about 10.5% compared to 2 years. We usually will check on that because that is a big number, and it's probably because, again, the higher sales, and we probably hired a few more people. Now, if it's a huge percentage, like a 30 or 40% increase, it may end up have to scale back in the next year. Negatives, we definitely check those out. Since this is an expense, we're good. That means we're lowering costs between the years. So we lowered it by 4.1%. Overall, interest, looks like the big one, probably take out more loans, so that's fine. And it's the bottom line. Look at that. So we basically increased from last year to this year 84.6% in net income, which is awesome. Most businesses don't do that. For this business, that's pretty good. So, and again, we go over the balance sheet, we look at those, and we see also what's going on. The other thing that we typically go after is also a trend. And this is basically, what direction is the business taking? So for our formula there, we can take any year that's after the base year amount, our base year. So we take any year, divide it by our base year, and times it by 100, again, for that percentage. So here, we're comparing what's going on in 2016, and we're going all the way to 2020. So, for example, how they got the 2020 number. We would have taken that 858,000 and basically divided by 750. And of course, times it by 100 to help you out or figure out percentage. So, basically, from 16 to 2020, our 2020 increased on the 2016 net sales by 114.4%. That's pretty cool. About 14% higher, not bad. But really, we do this for every year. And as you can see, they're about the same here, very close. But you start seeing the trend that they start to move higher. So we know we're going in a positive route. We're increasing our sales pretty much every year, which is not bad for an investor. Investor likes that. They're also going to probably check out your net income, probably some expenses, to see if they're also showing a positive trend. Really, when we analyze these, again, we're just checking to see what is happening with the company. When you take your auditing class, for those that are going to take capstone or take auditing in a 4-year, again, you're going to dive deeper into this. Here we're just, again, touching the basic points. So next, this is comparing within the company, how well the company is doing basically to itself. This vertical analysis is going to be more able for us to compare. We cannot compare based on horizontal to other companies, but we can do it with vertical. And there's pretty much a reason to that, and that is because vertical analysis starts to take out the dollar amounts. It's really more of a percentage of the total. So, it is a technique for evaluating financial statement data that express everything in a percentage. So to figure out these percentages, we're going to take a specific item, wherever we are going to use, and we're going to divide by the base amount. And the base amount is always going to be 100%. Okay? Will always be that way. And of course, times it by 100 to get the percentage. So, a few examples are basically, I want to figure out how much my current assets represent my total assets. Basically, specific amount is the current asset, and divide by the base amount I want to figure out from. So total assets. So we know current assets make up 22% of our actual total assets. Although this company has a lot of fixed assets. Or if you're looking at selling expense, as it relates to net sales, we would take selling expense, divide by net sales, which means basically for every dollar that we spend on net sales, or basically make, about 16 cents goes to selling expense. So, always great. But, as we move forward, this is how vertical analysis is going to look. Again, this is based on net sales. So you will actually go through each of these numbers as you go through, and you're going to do exactly the same thing since it's all based on net sales. For 2020, like cost of goods sold, I can take 513 divided by our sales. Again, I want times it by 100 just so that you can see. That's how we got their 59.8. So basically, almost over half of the money that we receive goes to basically cost of goods sold. But this will actually start narrowing it down. It's a little bit easier to look at in a percentage than it is dollar amount. Dollar amounts kind of give us that little bias. For percentages, very quick. So here I can also compare from 2020 to 2019. Here I can see cost of goods sold as a percentage went down. Even though it increased, dollar amount rise, like horizontal analysis will do, vertical analysis will actually show we have decreased the amount that we spend on cost of goods sold. This is why we use both horizontal and vertical to try to see what's going on. Again, we're going to look probably at differences to see if anything basically has affected, and basically that's be our comparative. We also do this with other companies within our industry, and that is known as a common size statement or a common size analysis. Again, these will only report percentages. That's what a common size income statement will do. And it's basically removing that bias, that dollar value bias, because when we compare numbers in absolutes, dollars, we tend to overthink. Again, all companies do their own items. They can make more money than us, but they may not be doing it as efficiency as us on expenses or any other items. So we want to draw out as much of a comparative advantage as we can. So removing the bias of looking at the absolutes, we're going to really just look at the relative terms or percentage. So here's the comparison between Smart Touch Learning versus the Learning School. And the big thing that sticks out first is that the Learning School, even though that they're in the same industry as us, their cost of goods sold is almost getting close to half of what we do. So we would question how are they doing that and see if there's anything that we can change to help better ourselves with cost of goods sold. Things that we do like is that our selling expense compared to the Learning School is lower, so we're doing something right there. And also right now, our interest expense, basically we can tell that most likely the Learning School has a little bit more debt to them. So they're doing more interest than us, maybe. And then revenue, you're probably making some money there. But we're definitely checking because overall, their net income from their sales, they make about 23.5% off of it. Or they get to keep that amount if you want to look at that. Well, we're only keeping 5.6%. That is a big issue going on. So this is where we can see how well are we doing and where are key areas that we probably need to work on. Another analysis that goes with vertical, we're just going to keep it like it is known as benchmarking. Okay? Mostly when we look at benchmarking, again, we're comparing companies' performance with best practices from other companies. Mostly we just take this statement right here and make it into a nice graph, usually a pie chart, because they're the best with percentages. So this is known as benchmarking against a key competitor. So right here is basically the statement up above, now broken down into a little graphic form, where you can see which are the biggest items that we have with each company. And the thing is, we all know we want that orange slice, that's net income, to be a lot bigger for us. Here, it takes up a lot of their circle. But again, cost of goods sold, you can see definitely with a graphic that is way bigger than what the learning school has. And we can compare. Another benchmarking is also against the industry average, which we can check on and look at, and it's going to basically mimic exactly the same things. We can create the common size income statement comparing our company versus the industry average and see how well we're doing, and then create the benchmarking, which is again just this graphic, just replacing learning school with the industry. That's really it with the vertical analysis. That's what we're going to get into. And then the last part, the last item is, of course, your ratios. And every ratio is back from all prior chapters. So, again, definitely have this ready for y'all for the exam so you can see these formulas, because these ratios are going to be there. So, of course, we have our first batch, which is all about evaluating the ability to pay current liabilities. Can we pay our bills? There's the working capital ratio, which again is the ability to meet its short-term obligations with current assets. Cash ratio, ability to pay current liabilities from cash and cash equivalents. Now, some of these are going to be brand new, because we did skip a chapter or so, especially the cash chapter. So, again, this is why I like this graphic, because it also provides all the information for each ratio, like the asset test ratio, which is our ability to pay all its current liabilities if they came due immediately. That's always a good one to know. And of course, the classic current ratio. Then we got these sets. Look at all these. Lots of fun. We have we're going to evaluate the ability to sell merchandise inventory and collect receivables, which of course has our inventory turnover. So basically how many times can we basically sell throughout our merchandise. Days sales in inventory, how many days that inventory is held in the warehouse. Gross profit percentage, which of course we're going to use quite a bit. Accounts receivable turnover ratio, and the day sales and receivable mimics your inventory. And then you got, of course, all these averages. Be careful of the averages. Remember, you need two numbers to make an average. So usually the beginning and the end. If we're comparing 2 years, basically it's just adding those 2 years, boom, for the current. But we'll go through some of those. There's some of those in the homework. We also have the ability to evaluate paying long-term debt, which is the classic debt ratio. How much assets is financed with debt to equity, which is basically, again, portion of liabilities related to total equity, or basically we can get even to equity finance if we want to, the equity ratio. But we have the times interest earned ratio, which is, again, the ability to pay interest expense. So we'll have those. That one's a fun one. I think we've had that before. We have profitability ratios, which of course, again, profit margin. That's income divided by net sales, which actually is part of our vertical there, if you thought that. We have rate of return, the asset turnover ratio, which again, how effectively, how efficiency a business uses its average total assets to generate sales. We have a fun one right here known as rate of return on common stockholders' equity, which is of course net income minus preferred dividends divided by average common stockholders' equity, which is the relationship between net income available to common stockholders and their average common equity invested in the company. Fun one. Okay. Earnings per share. That is, again, our net income minus preferred dividends. And this one's divided by the number of common shares outstanding. Odds on you're going to have to figure that number out by using par value and dividing it into how much money we have in common stock. That one pops up in the homework. I'll show you how to do that. And then the last batch, of course, evaluating stock as an investment. We have, which basically this is what investors look at a lot. One, basically everything from rate of return on the equity down is definitely, if you're going to be a stockbroker, you're going to look at. Which this includes price earnings ratio, market price divided by earnings per share, and that's basically the value of the stock market places on every dollar of a company's earnings. We have the dividend yield, which is the annual dividend per share divided by the market price, which basically says this is the percentage of stock market's value that is returned annually as dividends. Which of course you do want. You want to know how much should we actually receive annually? How much is returned? We also have the dividend payout, which is the annual dividends per share divided by earnings per share. And this is basically our ratio of dividends declared per common relative to the earnings per share of the company. Again, we're really checking how many times they issue out dividends, how much those dividends are, and really, are we going to be making any money off the stock sales? That's why investors really love companies that issue out dividends. And again, this is basically, as you can see, that's it for analysis chapter. And when we look at those, again, we're going to have lots of questions. We're going to be checking to make sure, hey, this number is way too high. What's going on here? Or this is too low. This is, we're going to be checking, and we're going to be asking these questions. This is a perfect chapter that leads into 2302, where you're kind of always asking these questions internally. How can I do better? Why am I not like my competitor? Is there something going on? Why is that number so high? And I mean, who are these clients? Now, if you ask who are these clients, they have some fraud going on. If you don't know them as an owner, you may double check. Same thing with like employees. In fact, I will already tell you, just reading the news, the new small business loan for payroll, PPP, triple P loan, there was already arrests happening for people creating fictitious companies to get these loans, to pay workers that don't exist. They got arrested already. We're going to find out how many years they're going to get for that. They're trying to dupe the government and try to make away with almost $500,000. People are always going to do that. They can find a loophole. They're going to try and take advantage of it and hope that they don't get caught. So, is there any questions regarding Chapter 15 and the tons and tons of formulas? You just want to see these in action, don't y'all? Alright, so I'm going to go ahead and wrap up this video. And we're going to go straight to the homework. This is the last chapter. This is basically the last lecture. So we're going to go straight to the homework and we'll go through that and I'll show you how to pinpoint these formulas and how to do them.